plan to continue shopping there. GameStop stores still provide real value to consumers and reliable revenue for GameStop. Second, I believe that GameStop has the potential to reinvent itself as the ultimate destination for gamers within the rapidly growing $200 billion gaming industry. GameStop has a unique opportunity to pivot toward a technology-driven business. By embracing the digital economy, GameStop may be able to find new revenue streams that vastly exceed the value of its business. I am hardly the only person who has advocated these points. When I wrote and spoke about GameStop on social media with other individual investors, our conversations were no different from people in a bar or on a golf course or at home talking or arguing about a stock. Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources. Social media platforms like Reddit, YouTube, and Twitter are leveling the playing field. The idea that I use social media to promote GameStop stock to unwitting investors and influence the market is preposterous. My post did not cause the movement of billions of dollars into GameStop shares. It is tragic that some people lost money, and my heart goes out to them. But what happened in January just demonstrates again that investing in public securities is extremely risky. As I said earlier, I consider myself and my family fortunate with our investment. When the stock price broke $20 in December, I knew my investment was a success. I was so happy to visit my family in Brockton for the holidays. The money will go such a long way for us. We had an incredibly difficult 2020. Most difficult was the tragic and unexpected loss of my sister Sarah in June. I am grateful to be in a position to give back to and support my family. As for what happened in January, others will have to explain it. It's alarming how little we know about the inner workings of the market. And I am thankful that this committee is examining what happened. I also want to say that I support retail investors' right to invest in what they want, when they want. I support the right of individuals to send a message based on how they invest. As for me, I like the stock. I'm as bullish as I've ever been on a potential turnaround for GameStop, and I remain invested in the company. Thank you. Cheers, everyone.
Thank you, Mr. Gill. Ms. Schlupp, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and distinguished members of the Committee on Financial Services. My name is Jennifer Schulp, and I am the Director of Financial Regulation Studies at the Cato Institute's Center for Monetary and Financial Alternatives. Thank you for the opportunity to take part in today's hearing. Before addressing the GameStop phenomenon specifically, I'd like to talk about the participation of retail or individual investors in our public equities markets. Retail participation has ebbed and flowed over the years, but the recent upward trend accelerated sharply during the pandemic. Most point to zero commission trading, but several other factors also likely attracted retail investors, including fractional share trading, low account minimums, and easy app-based platforms. More time at home during the pandemic probably even played a role. Retail participation in our equities markets is important. The fact that retail investors behave differently from institutional ones and differently from each other can be particularly valuable in times of market stress. In fact, individual investors may have helped stabilize the market in March 2020. Importantly, investing in the stock market also provides a path to wealth for individual investors. But stock ownership traditionally has been skewed towards the already wealthy, and it is highly correlated with race, education, and age. Retail investors making up this new surge are different. Recent research by the FINRA Investor Education Foundation and NORC at the University of Chicago found that investors who opened accounts for the first time in 2020 were younger, had lower incomes, and were more racially diverse. These new investors also held lower account balances. This may portend, as one of the researchers noted, quote, a shift towards more equitable investment participation. These new opportunities for individuals to grow their wealth should be welcomed and expanded, not restricted. Now I'll turn to GameStop. At the outset, I will note that it is difficult to analyze the impact of the trading in GameStop and other stocks because many facts are unknown. But some things seem clear. Importantly, the temporary volatility in these stocks did not present a systemic risk to market function. As the Treasury Department recognized, the market's, quote, core infrastructure was resilient during high volatility and heavy trading volume. This is not surprising. Despite the huge trading volume and rapid increase in value, only a small part of the market was affected, and spillover effects on the wider market were mild and short-lived. The fact that GameStop traded temporarily, and perhaps still trades above fair estimates of the company's value, is not, by itself, a reason for concern. Stock prices move in and out of alignment all the time, and markets are no strangers to bubbles. If a company is valued by the market differently than a review of its fundamentals suggests, it might indicate that the analysis is missing relevant information about a company's prospects, or it might indicate that the company's stock price is due for a correction. The market's mechanisms, including the tool of short selling, generally work well to handle these circumstances. Stepping in to prevent trading where a stock price moves contrary to conventional wisdom could deprive the market of important information. The SEC, among a host of others, is reviewing the relevant trading and conducting a study of the events. The SEC will have access to far more information than has been made publicly available, and I believe it has the tools necessary to address any harmful misconduct that may have occurred. I cannot opine on whether any regulatory changes are warranted on this incomplete record. I tend to believe the answer will be no in light of the minimal impact on the market's function. But as regulators learn more, there may be areas identified for improvement. By no means, though, should these events lead to restrictions on retail investors' access to the markets. Thank you, and I welcome any questions that you may have.
Thank you, Ms. Schlupp. I now recognize myself 5 minutes for questions. The market volatility surrounding GameStop and other securities has highlighted how many people feel that the cards are stacked against them and that market participants, like our witnesses, hide the ball. Mr. Teneve, you explained that Robinhood restricted transactions in certain securities to meet demands coming from your clearinghouse. And yet, on January 28th, you represented to the media that there was no liquidity problem. Isn't it true that being concerned about having enough capital to meet deposit requirements, isn't that a liquidity problem? Could you just answer yes or no?
Chairwoman Waters, I appreciate the opportunity to address that.
Just yes or no?
We always felt comfortable with our liquidity and the additional capital that Robinhood raised.
Please answer yes or no.
We always felt comfortable with our
5
liquidity.
minutes. I don't have time. I just need a yes or no answer.
I stand by my statement. The additional capital we raised wasn't to meet capital requirements or deposit requirements.
Gentlemen,
Excuse me.
I'm reclaiming my time. This liquidity problem had real consequences for your customers, but I wonder if they were all that surprised. Between December 2019 and December 2020, Robinhood customers experienced monetary losses due to system outages. Customer accounts were reportedly compromised. The firm repeatedly failed to testify its best execution obligations, and it misled its customers regarding its revenue sources. It seems retail investors often get a bad deal at Robinhood. Mr. Teneve, also, while you testified today that, quote, Robinhood's customers benefit greatly from payment for order flow, quote unquote. In December 2020, the SEC charged Robinhood for not disclosing that it was getting paid to send customer trades to Citadel Securities and other market makers, and for not seeking the best terms for its customers' orders. Robinhood provided such inferior trade prices, it cost your customers over $34 million. Is your testimony after Robinhood paid, is it your testimony after Robinhood paid the SEC $65 million to settle those charges that this conflict of interest is in your customers' best interest? Yes or no?
Chairwoman Waters, first, let me say regulatory compliance is at the center of everything that we do. We've made mistakes in the past. I'm not claiming that I'm perfect.
Yes or no to that question.
So Citadel Securities is an important counterparty. Nobody's denying that. The reason that
Gentlemen, can I answer yes or no? I'm reclaiming my time. Meanwhile, Mr. Griffin, Citadel's role in this event also raises significant questions for policymakers. Citadel Securities pays Robinhood tens of millions of dollars to process trades by Robinhood's customers. This relationship gives Citadel Enterprise key non-public information as to direction and volume of trades by retail investors. Your firm makes use of private exchanges called dark pools and other off-exchange trading to trade large sizes without moving the market against you. In fact, at some point last month, 50% of all trades occurred in dark pools or via OTC off-exchange trades. Your business strategy is designed intentionally to undermine market transparency and skim profits from companies and other investors. One problem, though, Mr. Griffin, is that we don't really know how central your firm has become to the capital markets. Mr. Griffin, does Citadel handle 47% of the U.S. listed retail volume? Please, yes or no.
Excuse me, Chairman Waters, what percentage? I couldn't hear that number.
47%.
So, Chairman Waters, to the best
yes
of
or no.
So the best of my knowledge, we handle in excess of roughly 40% of all retail volume.
Thank you very much for reclaiming my time. Mr. Griffin, on January 27, the Citadel execute 7.4 billion shares for retail investors, which would be more trades than the average daily volume of the entire United States equities market in 2019, yes or no?
Chairman Waters, that was my written and oral testimony.
Thank you very much. And with that, I now recognize the distinguished ranking member, Mr. McHenry, for 5 minutes for questions.
All right, thank you. Mr. Tanev, I'm going to come to you first. I just want to get to what happened on that day in January. So let's take a step back here. You get a call in the middle of the night, according to what I've heard you in interviews say. And based off that conversation with your compliance team, you decided to halt the buying of GameStop stock. People were furious. We'll get into the regulations and the settlement parts of that today. We will get to that. But this is what I think needs to be answered about your decision. Why did Robinhood restrict the buying but not the selling of GameStop? And why did folks get locked out on the buy side only?
Ranking Member McHenry, I appreciate the opportunity to address that. The reason that Robinhood, first of all, let me say Robinhood is always committed to providing access. It's in our name. It's in everything that we do. The decision to restrict GameStop and other securities was driven purely by deposit and collateral requirements imposed by our clearinghouses. So buying securities increases our collateral requirements. Selling does not. Moreover, preventing customers from selling is a very difficult and painful experience where customers are unable to access their money. So we don't want to impose that type of experience on our customers unless we have no other choice. And even though I recognize customers were very upset and disappointed that we had to do this, I imagine it would have been significantly worse if we prevented customers from selling.
Okay, so let me ask this question. Is payment for order flow legal?
Yes, payment for order flow is legal and regulated and a common industry.
And is this disclosed to those users of your app?
Yes, payment for order flow is disclosed in multiple places. And moreover, payment for order flow enables commission-free trading. And that's why it's become the industry standard model as other brokerages have replicated our model and started offering commission-free trading to their customers as well.
Okay, so to that to this greater point of what happened that day and the model that you're using, let's be crystal clear. That decision you made to restrict the buying but not the selling of GameStop was based. What was it based on? Pressure from anyone on the witness panel here today?
Not at all. Zero pressure from anyone. It was a collateral depository requirement decision made by our Robinhood Securities president.
All right. So let me get into this other question. Let me get into this question. You want to democratize finance. You want to open up Wall Street to retail investors. You say that Robinhood's mission is to democratize finance for all. So let's talk about that. So yes or no? Can a Robinhood customer invest in Robinhood, the company?
Robinhood's currently a private company, so that's not possible, no.
And so you mean to tell me that the people that use your platform, that make you a successful company, and I would say directly contribute to your company's exponential growth and success, they don't get the same access to equity shares as a Robinhood employee or your institutional investors. Is that correct?
Currently, that is correct, yes.
All right, Ms. Schultz, let me pivot to you. Why is that? Why is it that everyday investors on the Robinhood app, people that I would argue contributed to its success, can't invest in Robinhood itself?
The SEC limits a lot of investment in private companies to those folks that are known as accredited investors. And to become an accredited investor, you have to have meet a wealth test of earning at least $200,000 a year, or having a net worth of over $1 million. The vast majority of people in this country don't meet that standard and are unable to invest in most private companies.
Okay, so let me just clear this. Mr. Tenev, I don't blame you for the restriction you put on your customers not being able to invest in equity. I'd like to have more opportunity to ask Mr. Gill his thoughts on this, but let me just say this. I don't fault you for the inequitable regulatory structure that DC has created, but I think we need to clear this up. Final thing, Madam Chair, I have for the record, I'd like to submit a letter from the DTCC, which is the clearing company, that was not on the panel today, and your staff has this letter already.
Order.
All right, thank you all, and look forward to getting to the facts of the matter here today.
Other members, Ms. Maloney.
Thank you, Chairwoman Waters and Ranking Member McHenry for convening this hearing. I hope today's hearing sheds light on how our markets are working, or in many cases are not working, for smaller investors and ways we can fix that. The events of late January saw tremendous volatility and stock prices that were totally divorced from market fundamentals. The whole enterprise was viewed by some as a giant video game, trading stocks instead of properties and monopoly money. But it's not all fun and games, because people can lose their life savings, their hard-earned cash, and tragically, last summer we know of at least one suicide linked to potential trading losses. Beyond those possible losses, the actions of Robinhood and other trading platforms during the GameStop frenzy caused confusion, anger, and undermined investor confidence in the fundamental fairness of our capital markets. None of this is healthy for our markets or good for investors. What makes markets work fairly is when everyone knows the rules and that the rules remain consistent and predictable and are enforced. But because of Robinhood's actions, too many customers did not get that predictability. Many retail investors woke up on January 28th to find that they could no longer buy and sell stocks the same way they could the days prior, and they were being treated differently than other market participants who could still buy and sell those same stocks. So I don't blame them for thinking that things were stacked against the little guy. Mr. Tenev, you stated in your testimony that Robinhood restricted trading for certain securities, including GameStop, in order to meet your financial requirements with your clearinghouse. But when I go to Robinhood's